What is net income? This segment's learning objective is to explain the nature of net income, revenue, and expenses. Net income is an increase in owner's equity that results from the profitable operation of a business during an accounting period. Net income also may be defined as revenue minus expenses. Revenue is the price of goods sold and services rendered to customers during the period, and expenses are the costs of the goods and services used up in the process of earning revenue. Net income, the excess of revenues earned over expenses incurred, is not an asset. Net income increases owner's equity by increasing retained earnings. When a company earns income, assets must increase, or liabilities must decrease to reflect the earnings process. Remember, when Overnight Auto Service rendered services to its customers, the asset account cash increased, and so did the owner's equity account, retained earnings. Net income always represents an increase in the owner's equity of a company. Owner's equity is comprised of capital stock and retained earnings. The retained earnings account represents all the accumulated earnings of the company since inception that have not been paid to owners. The balance in the retained earnings account represents the total net income of the corporation over the entire lifetime of the business, less all amounts which have been distributed to the stockholders as dividends. An income statement is a financial statement that summarizes the profitability of a business entity for a specified period. In this statement, net income is determined by comparing sales prices of goods or services sold during the period with the costs incurred by the business in delivering these goods or services. The technical accounting terms for these components of net income are revenue and expenses. Therefore, accountants say that net income is equal to revenue minus expenses. Should expenses exceed revenue, a net loss results. Income must be related to a specified period. Notice that our sample income statement covers a period, namely the year 2018. A balance sheet shows the financial position of a business at a date. We cannot evaluate net income unless it is associated with a specific period. For example, if an executive says, "My business earns a net income of $10,000, the profitability of the business is unclear. Does it earn $10,000 per week, per month, or per year?" The late J. Paul Getty, one of the world's first billionaires, was once interviewed by a group of business students. One of the students asked Getty to estimate the amount of his income. As the student had not specified a period, Getty decided to have some fun with his audience and responded, "About $11,000. He paused long enough to allow the group to express surprise over this seemingly low amount, and then completed his sentence, "An hour." The period covered by an income statement is termed the company's accounting period. To provide the users of financial statements with timely information, net income is measured for relatively short accounting periods of equal length. This concept, called the period principle, is one of the underlying accounting principles that guide the interpretation of financial events and the preparation of financial statements. The length of a company's accounting period depends on how frequently managers, investors, and other interested people require information about the company's performance. Every business prepares annual income statements, and most businesses prepare quarterly and monthly income statements as well. Quarterly statements cover a 3-month period and are prepared by all large corporations for distribution to their stockholders. The 12-month accounting period used by an entity is called its fiscal year. The fiscal year used by most companies coincides with the calendar year and ends on December 31st. Some businesses, however, elect to use a fiscal year that ends on some other date.